Over the last 5 years, CG Power delivered a return exceeding 1,000%. It climbed from the absolute brink of corporate collapse to a market capitalization of over 1.36 trillion rupees. To understand if that valuation holds weight today, we are executing an institutional research teardown. We will strip away the market sentiment and run an emotionless, data-driven evaluation across more than 30 financial metrics. The company's economic moat lies exactly in the middle of the B2B power value chain. They do not generate electricity. Instead, they manufacture the critical hardware, like transformers and switchgears, required to transmit and distribute power safely across the grid. This diagram illustrates the corporate hierarchy. Tube Investments, part of the Murugappa Group, controls the entity. The revenue engine splits into 2 main divisions, Power Systems and Industrial Systems. The Industrial Systems branch acts as the volume driver. This division handles the high-volume manufacturing of motors and factory automation equipment, serving heavy industrial clients and rail operators. Recently, management introduced a massive variable into their capital allocation. They committed 76 billion rupees to build outsourced semiconductor assembly and test facilities, directly integrating with the India semiconductor mission. This research note confirms the exact allocation. The G1 facility in Sanand is currently operational at a peak capacity of 500,000 units per day, with the G2 facility slated for completion by the end of 2026. CG Power is executing a hard pivot. By transitioning from a legacy electrical manufacturer into a high-tech infrastructure and semiconductor play, the company has attracted aggressive institutional capital, willing to pay premium multiples for future growth. That premium pricing results in the current market reality. The company holds a 1.36 trillion rupee market capitalization, supported by the largest unexecuted order book in its history. This visualizes the scale of the company's surging demand. Unexecuted orders surged 45% year-over-year, peaking at 17,333 crore rupees. Standalone net profit jumped 27% to hit 364 crore rupees. Top-line revenue increased 16% to 3,061 crore rupees. Management expects to sustain this trajectory over a 5-year horizon by expanding their export market, which currently accounts for only 5% of sales, and by fully commercializing their higher-margin 400 and 765 kV GIS products. This metric tracks their operational efficiency over time. Core EBITDA margins climbed from 11.71% in March 2022 to a peak of 14.03% in March 2024. By March 2026, margins slightly compressed to 13.06%. Management minimized commodity inflation by exercising strict pricing power. These metrics validate the operational turnaround. The business is executing at a high level. However, robust sales growth and a massive order backlog do not automatically justify a trillion rupee price tag. To price this asset correctly, we have to address the forensics. Just a few short years ago, this exact corporate entity was the site of a massive accounting scandal. This document is the 2022 final order from the Securities and Exchange Board of India. It details a 1,053 crore rupee fraud orchestrated through related party transactions during the Gautam Topper era. Liabilities were deliberately understated. Advances were routed to unrelated parties. The regulatory fallout pushed the company to the brink of insolvency. The recovery required a complete teardown of the corporate structure. Tube Investments acquired the distressed asset, overhauled the corporate governance framework, and aggressively aligned the internal auditors to clear the regulatory red flags. This balance scale demonstrates the cleanup. Today, the net debt-to-equity ratio is negative 0.16. CG Power operates as a net cash company. Their EBIT to interest coverage is an overwhelming 100 times, providing absolute capacity to service obligations. Management excised the toxic leverage and governance issues of the past. The resulting fortress balance sheet gives them the exact financial flexibility needed to self-fund their semiconductor capex without taking on dangerous debt. We will use this teardown dashboard to test if the market has aggressively overreacted to that clean balance sheet. The scorecard reveals red flags. Trading at a PE of 111 and EV to EBITDA of 89, a PEG of 4.9 signals severe overvaluation. However, they deliver elite efficiency. Return on equity hits 32% and ROCE tracks at 27%. cash generation remains highly robust, and promoter pledging is at absolute zero. The founding management maintains a steady 56% holding in the stock. Here is the core asymmetry of CG Power. It is an operationally pristine business that the market has priced for absolute perfection. At these multiples, any minor operational delay in their new semiconductor facilities will trigger a violent contraction in the stock price. To understand why the price remains elevated, we have to zoom out and observe how institutional capital treats the broader industrial sector. This chart maps the heavyweights. CG Power's $1.36 trillion market cap competes with Siemens at $1.31 and ABB India at $1.56. It boasts a 28% annual return, outperforming peers like Waaree Energies, which contracted 15%. That outperformance is highly dependent on securing government backing. The primary regulatory risk to their future growth is successfully executing the OSAT facility and claiming the approved 35 billion rupees central government subsidy. Switching to technical analysis, the price momentum is undisputed. The stock surged 65% from its 52-week low to around 867 rupees. This candlestick chart details the daily price action. The stock rides cleanly above the 20, 50, and 150-day moving averages, confirming a textbook uptrend. Oscillators like the MACD and Relative Strength Index support this bullish action, showing zero signs of bearish divergence. The technical momentum is completely ignoring the fundamental overvaluation. The stock price is currently being driven by heavy ETF flows and sector tailwinds, rather than its intrinsic fair value. By stripping away the institutional hype, we can construct our final valuation scenarios based strictly on mathematical realities. This dial graphic illustrates the alpha spread base case. If the EV to EBITDA multiple merely reverts to its 3-year mean of 73.6, the fair value drops to 704 rupees. That is an 18% downside from current levels. Conversely, this Motilal Oswal research exhibit models the institutional bull case. Using a sum of the parts valuation that assigns a heavy premium to the upcoming semiconductor facility, they arrive at a target price of 940 rupees. The math dictates the reality of your return profile. Achieving a 15% annual growth rate from an entry point of 111 times earnings is historically improbable for heavy industrial hardware. As we compile our final scorecard, the duality is obvious. The fundamentals and balance sheet earn a flawless A+. The valuation receives a failing D. For new capital looking to deploy, the definitive recommendation is avoid. The margin of safety at this price point is 0. For existing shareholders who entered at a lower basis, the recommendation is hold. The unprecedented 17,000 crore order book provides enough revenue visibility to prevent an immediate fundamental collapse. CG Power serves as a masterclass in corporate turnarounds and lean operational execution. But smart investing requires a margin of safety. Right now, the price of admission into this financial fortress is simply too high.